17 of 21 series are aligned with expansion strong this morning. That is broad mathematical agreement across the macro dashboard. The current macro regime is expansion strong, with a confirmation score of 17 out of 21. The macro regime red is straightforward in mathematical terms. Growth momentum is accelerating at plus 0.11, while inflation momentum is decelerating at minus 0.00. That combination matters because it describes a backdrop where the economy's growth composite is strengthening even as the inflation composite cools on the margin. The coherence score is 17 of 21 aligned, and the confirmation score is also 17 out of 21, which places this regime in a moderate to strong agreement band by the framework's history. Compared with last week, the Atlanta Fed's GDP tracker improved over the past 2 sessions, and that is the largest recent mover in the data. Historically, environments with this structure have often felt like a constructive mix for cyclical leadership, steadier credit tone, and softer gold performance. A record of past behavior, not a forecast. The question for the reader is not what the market must do next, but whether this configuration confirms the prices already being paid across assets. Treasury yields remain central here. The 10-year Treasury yield is 4.72%, and the 2-year sits at 4.25%, which leaves the curve mildly positive. On the framework scale, that yield posture is green, defined as a rate backdrop that remains firm enough to support the growth narrative without flashing acute stress. In our framework's reading of comparable periods, this roughly coincided with calmer credit and more durable cyclical participation within subsequent weeks to months. An observation under our methodology, not a forecast. What markets watch in plain terms is whether borrowing conditions are easing, tightening, or simply staying restrictive. The question is whether this yield level reinforces current equity pricing or challenges it. What would challenge this read is a clean move higher in the 10-year accompanied by a loss of breadth in risk assets. Employment is the softest major macro note in the last 24 hours. The report on July non-farm payrolls was the weak surprise that changed the tone around Fed pricing. On the framework's historical red, that is red for labor momentum, defined here as a downside impulse in payroll growth and related hiring data. In our framework's reading of comparable periods, this roughly coincided with a lower confirmation profile in later weeks when weakness persisted. A record of past behavior, not a forecast. Labor data matters because it tells participants whether demand, income, and policy flexibility are holding together. The question is whether this softness stays contained or starts to challenge the current growth picture. What would weaken the read is a re-acceleration in hiring or a rebound in labor demand measures. Credit remains calm enough to keep the regime coherent. The high-yield credit spread backdrop has not shown acute stress, and that supports the broader expansion red. In framework terms, that is a green credit signal, defined as spreads that stay contained rather than widening sharply. In our framework's reading of comparable periods, this roughly coincided with stable risk appetite and orderly sector rotation within the following weeks. A historical characterization, not a forecast. Markets watch credit because it is a direct read on default fear and funding strain. The question is whether current spread levels are pricing enough caution, and what would challenge the read is a fast widening in high-yield spreads or a visible break in market participation. The sector tape is also consistent with the macro framing. Technology has been the softer pocket on a recent pullback, while energy, utilities, and industrials have shown relative strength. That kind of rotation is a green to mixed equity signal in the framework, defined by leadership shifting without broad liquidation. In our framework's reading of comparable periods, this roughly coincided with a market that kept rotating beneath the surface rather than unraveling outright within the next several sessions. The question is whether leadership remains concentrated or broadens out. What would challenge the read is a deeper loss of participation across the major cyclical groups. 2 conditional markers sit on the map. If the 10-year Treasury yield crosses 4.45% and holds for 5 consecutive sessions, in our framework's reading, inflation composites showed acceleration in 9 of 11 comparable conditions. A historical characterization, not a forecast. That would move the regime conversation toward a more rate-sensitive posture. If the Fear and Greed Index drops below 15 and holds for 5 consecutive sessions, confirmation deteriorated in 7 of 9 comparable instances. That would matter because it would mark a loss of coherence across risk assets. The map is live. These conditions are being monitored daily across all 21 series. The Given Engine is the automated rules-based engine inside Given Analytics. It does 2 things in parallel. First, it publishes a view of the macro environment, the regime, the confirmation score, and the historical base rates already described. Second, it runs a fixed 4-layer mathematical framework: price structure, rate of change, risk regime, and market participation, across 407 symbols every trading day. When all 4 layers agree on a symbol, the Given Engine records it as an upside-aligned or downside-aligned condition for members to study. That is a reading of how the 4 layers line up, not a list of trades. These are time-stamped model readings, logged for members to study. The environment view and the condition log sit side by side inside the Given Engine. They are separate outputs. The regime does not pick the symbols, the 4 layers do. Members use the Given Engine to study how the framework has recorded conditions across prior environments, independently of regime, across 407 symbols in the same 21 series backdrop. The Given Engine runs the framework, the Given Engine logs the conditions, and the Given Engine keeps the context visible. May, potential, educational. Every trading day, this is free. Watch real symbols go active in live markets at the price it's happening. See which sectors are leading and learn to read what's driving it yourself. That live view is the observation desk. The same 21 series and 407 symbols founding members study each morning, the environment underneath every move. If you want to watch it alongside us, the live view is at givenanalytics.com. Free to try, no credit card, for the first 500 founding members. Watch it before you risk $1. You decide.